Hey everyone, it's Julie here with TipRanks, and today we're taking a look at whether it's time to buy the dip on these three tech stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at three tech stocks that have been dipping in price lately but still come in with a strong buy consensus from Wall Street. So we're going to take a look at these companies, what it is that they do, and what Wall Street is predicting for the stock's turnaround. We found these stocks using the TipRanks Stock Screener. Found right underneath research tools with the stock screener, I wanted at least a neutral or outperform rating on the SMART score, upside potential of over 20%, and a strong buy consensus. But then I went into our columns here and added in their performance year to date and within the last 3 months, and actually sorted by those that were in the red to find our stock ideas today. You can try the stock screener for yourself over on the TipRanks website or by downloading the TipRanks app on your mobile device. Links are in the description down below. Just before we get into today's stocks, this is a friendly reminder that if you enjoy the video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's get right into our three tech stocks. First on the list today, we're taking a look at Allegro MicroSystems. They trade under the ticker ALGM, currently priced just above $24 per share. Overall, the stock is down 9.3% in the past year, and in the last 6 months has dropped 19%. They do score an 8 out of 10 on the TipRanks Smart Score, and hedge funds have been scooping up shares, increasing their holdings by 1.7 million shares last quarter. Allegro MicroSystems is a chip maker specializing in integrated circuits, particularly for various sensors and application-specific analog power systems. These chips have proven essential in the automotive industry, where they are vital components of autonomous driving systems. In addition, Allegro's chips have found application in EV charging systems, industrial regulators, and various motors and motorized conveyor systems. The company has expanded its customer base to include industrial factories and energy and infrastructure providers. Allegro will be sharing their Q2 earnings report in just a couple of days on October 31st. This does follow a Q1 earnings and revenue beat back in August. For their second quarter, analysts are anticipating earnings per share of 6 cents, which would be a 2-cent increase over last year's. For their Q1, they reported earnings per share of 3 cents, which beat estimates by 1 cent per share, and revenue came in at $167 million, beating expectations by nearly $2 million. During the first quarter, the company also made $50 million of voluntary debt repayments and announced a repurchase of 39 million shares from their majority stakeholder. Back in September, a 5-star analyst from UBS initiated coverage on the Allegro stock with a buy. They said that the street appears to be underestimating the cyclical recovery ahead for the company, as estimates seem to bake in no pricing or share gain potential. The firm says Allegro's auto revenues appear among the most de-risked in the entire analog universe. And it seems other Wall Street analysts agree. With 6 current analyst ratings, the Allegro MicroSystems stock does come in as a unanimous strong buy. The average price target comes in at $32.20, implying an upside potential of nearly 34%. Looking at those ratings down below, all of them with double-digit upside. Our low-end price target is here from TD Cowen back in August, with an upside of nearly 17%, while our high-end price target does come from Evercore at $35 for an upside of 46%. Number 2 on our list today is Power Integrations. They trade under the ticker POWI, currently priced at about $65 per share. Overall, they're down 3% in the past year, and in the last 3 months have fallen over 8%. They're currently a neutral score of 7 on the TipRanks Smart Score. Power Integration is a semiconductor company that develops high-voltage power conversion components and technologies. Their products include integrated circuits, diodes, and gate drivers that are used in a variety of electronic products. Their products are designed to be smaller, more reliable, and more energy efficient. They are lead-free, halogen-free, and comply with the EU's Restriction of Hazardous Substances Directive and REACH regulation. Plus, their EcoSmart technology reduces the amount of energy that electronics and appliances waste when they are idle or in standby mode. Back in 2022, their EcoSmart technology saved an estimated 16 terawatt hours of electricity. Their Q3 earnings report will be coming out shortly in about a week's time on November 6th, and this does follow an earnings and revenue beat for their second quarter. For their third quarter, analysts anticipate earnings per share of 36 cents, and that would actually be a decrease from last year's. Looking back at their second quarter, earnings per share of 28 cents beat expectations by 2 cents per share, while revenue of $106.2 million did exceed expectations by about $1.2 million and was up 16% from the prior quarter. Management said that their second quarter revenues rebounded as expected, and while demand continues to be soft and visibility limited, we expect another sequential increase in the third quarter driven by by lower distributor inventories and new design wins. They also expect a further increase in their gross margin. The most recent buy rating on Power Integrations comes from an analyst at Benchmark. The analyst noted that despite a prolonged downturn, the company's expanding range of products, leverage across various markets, and a pipeline brimming with design wins are poised to accelerate its growth trajectory in the following year. Their core growth vectors are supported by enduring market trends, offering substantial opportunities for content and serviceable available market expansion. They expressed confidence in the company's operational execution and anticipate a resurgence in its historical growth and earnings strength. The stock does just have 5 current analyst ratings, but comes in as a strong buy with 4 buys and 1 hold. The average price target comes in at $80.60, implying an upside potential of about 24%. Looking at those ratings down below, a lot of them back from August, and we'll see them reiterate following this next earnings report. But our low-end price target is a hold from TD Cowen with an upside of about 7.5%, while our high-end is $95 from Stifel for an upside of 46%. If you've made it to our third stock today, then this is a reminder to make sure you hit that thumbs up button. Last but certainly not least, we're looking at Baidu. They trade under the ticker BIDU, currently priced at $93.66. Overall, in the past year, the stock is down nearly 12%, and in the last 6 months is down over 9%, though we did see a little resurgence here recently. They score a 9 out of 10 on the TipRanks Smart Score, and this is another one that we see hedge funds increasing their position in, last quarter increasing their holdings by 2.8 million shares. And this stock does hold a large position in Michael Burry's Scion Asset Management and is one of his top holdings. Baidu is a Chinese technology company that provides a variety of internet services and artificial intelligence developments. Their primary business is internet search in the China market, and they are the leading search engine in the country with features and services similar to Google's. Their flagship app also provides access to search, newsfeed, content, and other services, along with an online encyclopedia, and they have iQIYI, which is a video streaming service too. They use artificial intelligence in many ways, including their AI-powered search and chatbots, cloud services, disease detection and temperature measurement, as well as AI-powered autonomous vehicles. Their next quarterly report is still a few weeks away, due out on November 21st, and does follow a mixed result for their second quarter. For their Q2, they reported earnings per ADS at $2.95, which did beat expectations by 35 cents per share. Revenue came in at $4.67 billion, which was fairly flat year over year, but did slightly missed estimates by just $70 million. They said that AI Cloud continued to accelerate in the second quarter, and they also achieved new breakthroughs with their Apollo Go, which now offers 100% fully driverless ride-hailing services. They said that gradually the transformative impact of Gen AI and foundation models is becoming more tangible in business and everyday life. In recent months, we have seen several analysts slightly lower their price targets on the Baidu stock, but all while maintaining a buy rating. One of those was a 5-star analyst from Susquehanna. They said that Baidu continues to face a challenging macro environment, which, coupled with headwinds from its AI-powered search experience, caused some pressure on the top line. Management is focused on what it can control and remains optimistic that generative AI initiatives can help re-accelerate growth over time. Baidu does have 13 current analyst ratings, coming in as a strong buy with 10 buy ratings and 3 holds. And even with analysts lowering price targets, the average of $126 would still imply an upside potential of about 35%. Looking at those most recent ratings there, our low-end price target is a buy rating from Susquehanna at $105, which would still be an upside of 12%. Our high-end price target comes back in August here at $180 for an upside of nearly 93%. So that is a quick look at 3 tech stocks that have been in the red this past year, but analysts think have the potential for growth in the year ahead. Let me know your thoughts on these 3 companies in the comments down below. I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you stick to your own investment plan. Thank you guys so much for watching. Have a wonderful day, and I'll see you back here next time.